First, it was your electrical bill. Now your gas bill is creeping up. Even at the pump, prices started moving again. Why? Most people are told it's inflation or politics, but underneath all of that, something deeper is happening. What happens when energy systems get stressed and financial systems get restricted at the same time? They don't stop, they adapt. In Venezuela, we saw one version of that adaptation, stablecoins becoming financial infrastructure. In Iran, something different happened. Electricity started turning into Bitcoin. And once you see that pattern happen, you realize this isn't just geopolitics. It's systems under pressure finding new ways to move value. Welcome back to the New Financial World Powering Tomorrow podcast, the show where we don't chase headlines, we break systems down. Energy, finance, and technology, not as trends, but as forces shaping how the real world actually works. I'm your host, Zakir, and I appreciate you coming back. And if you're new, welcome. If you enjoy breaking down how these systems connect, consider subscribing so you don't miss out on future episodes. And if something in today's discussion sparks a thought or a different perspective, drop it in the comments. I definitely read them, and I appreciate seeing how others think about these systems. But before we dive in, quick disclaimer. This show is for educational, informational, and entertainment purposes only. Nothing you hear should be considered financial, legal, or tax advice. Always do your own research and consult a licensed professional before making any decisions. All viewpoints expressed on this channel are my own and are not of any employer or organization. Now, let's get to it. Right now, when people talk about Iran, they focus on three things: nuclear risk, regional conflict, and global energy stability. Because Iran sits inside one of the most critical energy corridors on Earth. The Strait of Hormuz. The Strait of Hormuz holds roughly 20% of the world's oil supply, moves through that narrow waterway. And when that corridor is threatened, even slightly, energy markets react immediately.
This is Democracy Now!, democracynow.org. I'm Amy Goodman with Nermeen Sheikh.
Global oil and natural gas prices are soaring after Israel bombed a massive natural gas reserve in Iran, the largest in the world. Iran retaliated by twice attacking the world's largest liquid natural gas production facility located in Qatar. Iran also attacked key energy infrastructure in Saudi Arabia, Kuwait, and the United Arab Emirates. At one point today, the price of oil reached $118 a barrel, a 60% jump since the U.S. and Israel launched its war on Iran. In a post online, Trump threatened to blow up the entire South Pars gas field if Iran continues to target the Qatari facility. Trump also claimed the U.S., quote, knew nothing about the Israeli attack on the South Pars gas field. But the Wall Street Journal reports Trump approved the strike to pressure Iran to open up the critical Strait of Hormuz.
About 20% of the world's oil exports flows through the Strait of Hormuz. President Trump's asked other countries to send warships to help force open the strait, but many nations are rejecting the request. We're joined now by Lala Khalili, professor of Gulf Studies at University of Exeter and the author of several books, including her latest, Extractive Capitalism: How Commodities and Cronyism Drive the Global Economy.
And we saw this recently because we saw the oil prices move and the natural gas tighten. And those moves don't stay on trading screens. They show up in your life, at the pump, and on your utility bill, in your heating and electricity costs. During periods of heightened tension, natural gas prices have seen sharp spikes, sometimes 20 to 40% in short periods, depending on supply constraints and seasonality. And when gas tightens, something interesting happens. Coal, which many assumed was in long-term decline, now coming back into the mix.
And now let's get to investor number 3, whose trades look very different from the two we've looked at so far. Monish Pabrai is playing a completely different game, which makes sense considering he's a value investor searching for companies at a discount, and he's a disciple of Warren Buffett's value investing style. So his latest 13F filing very much reflects this value investing approach, and it's already paying off pretty well this month. So you can see immediately, Pabrai's portfolio is super concentrated. There's no AI software or big tech to be seen. Instead, his largest additions are in coal companies and offshore drillers. So let's look at why Pabrai is buying these stocks, and it actually goes deeper than just that they're cheap. With demand still increasing in markets like Asia, and today with added electricity demand for AI data centers and more steel production, that increased demand could send downstream increases to the total coal demand. This is an example of the famous downstream or second order effect that Warren Buffett's longtime partner Charlie Munger said is the key to a good investment. He's buying into stocks like AMR, a small coal mining stock that's off its high so far in 2026, and holding $158 million in Warrior Met Coal, another small metallurgical coal company. It's a very unglamorous, capital-intensive business, but Pabrai is known for investing in industries that the rest of the market hates or overlooks. So AMR and Warrior Met Coal both focus on metallurgical coal production, so the coal used in creating things like steel rather than energy. So in this chart of total coal demand, it's not this big chunk, it's this smaller chunk right here. But the pricing here tends to follow a similar pattern, with metallurgical coal demanding a premium and being more volatile overall. AMR leadership has been aggressively buying back shares, holds a ton of cash, and they are currently rated as 30% undervalued by Investing Pro. Here's the first one. Energy demand is still rising worldwide, with much of that coming from China, and oil companies expect their demand for oil to keep on rising in 2026. But there is one big risk here for investors, and that is that this is a cyclical industry. So I'll show that definition on screen again. These are not like software as a service stocks that tend to grow revenue every quarter. The ride in these companies is going to be bumpy. So if you buy these stocks, you pretty much need a long-term focus, and you need to keep a close eye on value, make sure that management continues to buy back shares, and keep an eye on global politics and conflict that can affect these companies.
Globally, coal still accounts for roughly 35% of electricity generation. And when systems get stressed, demand for it rises. Not because it's preferred, but because it's available and reliable. That tells you something important. This isn't just another commodity. It's a strategic layer of global systems. But even that framing is incomplete because it tells you what is at risk, not how systems respond. Because on this show, we don't just ask what governments say. We ask what systems do. And once you start looking through the lens of energy, finance, and infrastructure, a deeper pattern starts to appear. If you've been listening to this podcast from the beginning, you've seen this pattern before. Back in episode 1, The Venezuela Signal, we talked about what happens when three pressures collide: energy constraints, financial constrictions, and critical infrastructure stress. And the key idea was simple. Systems don't wait, they adapt. Venezuela showed us one version of that. Stablecoins emerging as a way to move value when traditional rails break down. So today isn't a new concept, it's the next variation. Iran has something Venezuela didn't have at scale: massive, accessible energy. One of the largest natural gas reserves in the world, significant oil production capacity, and critically, the ability to generate electricity at scale. Now here's where the shift happens. In the digital era, energy doesn't just power industry, it powers computation. And computation can generate digital assets, which means energy itself can now be converted into value. This is where Bitcoin enters the picture. Bitcoin mining works like this. You run specialized machines, they consume electricity, and in return, they produce Bitcoin. Electricity, computation, digital asset. And this isn't theoretical. At one point, reports show Iran accounted for roughly 4 to 5% of global Bitcoin mining, generating close to $1 billion annually. And the energy behind that, roughly the equivalent of 10 million barrels of oil annually being converted directly into Bitcoin. The exact number matters less than what the process allowed, because once electricity is converted into Bitcoin, that value is no longer tied to physical transport. No tankers, no pipelines, no banks required to approve it or to move it. Just a network and a wallet. So in Iran, you get this unusual blend. Electricity goes in, Bitcoin comes out. Oil and gas still drive the economy, but now portions of that value move through Bitcoin and digital stablecoins instead of traditional banking rails like SWIFT. Energy becomes money, and that money moves on different rails. But Iran's crypto policy contains an interesting contradiction. The government allowed Bitcoin mining while restricting domestic crypto trading. If at first glance that seems inconsistent or backwards, but it's not. Mining and trading serve different purposes. Mining brings value into systems. Unrestricted trading can let value leave. So the state draws a line. Production supports strategy while uncontrolled flow creates risk. This wasn't about ideology. It was about utility. Once Bitcoin is mined, it doesn't just sit in the wallet. It starts to behave like export revenue. Picture a sanctioned industrial buyer that needs replacement parts or even special parts. Wiring money through traditional banks, we all know is slow today. And it could also be flagged and completely blocked. But a state-aligned mining operation has steady flow of Bitcoin coming in. That mining entity sends Bitcoin to an overseas intermediary, someone operating in the gray zone between finance and logistics. The intermediary converts part of that Bitcoin into a local currency or dollar stablecoin and pays a supplier that ships the equipment. On paper, it looks like normal commerce transaction. Underneath, the value that funded it started as electricity. Trade still happened, not through corresponding banks, but through chains of wallets, off-ramp desks, and settlement networks. That doesn't replace global financial systems. It creates a parallel channel. And those channels grow fastest where access to traditional rails is weakest. Bitcoin solves one side of the problem, creation. But global trade is still priced in dollars. And that's where stablecoins come in, not as speculation, but as interface. A supplier may not want Bitcoin on their balance sheet, but they're comfortable invoicing in something that tracks the dollar. So somewhere in that chain, often an exchange or OTC desk, Bitcoin gets converted into dollar stablecoins. From there, payments start to look familiar again. A buyer sends digital dollars, a supplier receives a dollar balance that can off-ramp into their local banking system. No corresponding banks, no SWIFT messaging. But the unit of account still feels like the old world. That's the quiet shift. The form of payment changes, wallet-based settlement instead of bank wires. But the mental model stays the same. And that's why these systems work in trade without requiring everyone to become crypto native. When you zoom out from the mechanics, Iran stops looking like a one-off headline and starts looking like a pattern. Sanctions restrict access to formal financial rails. Energy becomes the alternative input. Digital networks become the routing layer. And Bitcoin, stablecoins, and intermediaries become the instrument that tie it all together. The result isn't a clean replacement of the global financial system. Really, it's not trying to replace the global financial system at all. But what you'll have is a parallel layer that plugs into the old system just enough to stay useful. But it still stays outside just enough to avoid control. And here's the real signal. Once a country learns how to turn electricity into a sanction-resistant value, that capability doesn't disappear. It becomes part of the playbook. You're not just watching a workaround. You're watching a new layer on the system being built at the edges, where pressure is highest. We're moving into a world of layers, official systems, regional systems, and open digital networks. Iran just happens to be one of the places where those layers collide under pressure. The story of Iran and crypto isn't really about Bitcoin. It's about infrastructure. It's about what's happening when financial rails close and new ones appear. Sanctions restrict bank access. Energy creates new opportunities. Digital networks create new settlement pathways. And suddenly, electricity becomes something more than power. Because in the modern economy, electricity doesn't just power industries. Sometimes it powers money itself. Thanks for listening to the New Financial World Powering Tomorrow podcast. If this episode gave you a new way to think about how energy, finance, and digital infrastructure connect, drop a comment. I'd love to hear your perspective on these converging markets. And if you enjoyed it, like and subscribe and share it, especially with someone who still thinks crypto is just prices and charts, or whoever likes to understand systems behind the headlines. Until next time, learn, adapt, and prosper. And as always, stay energized.